And if gold goes up, but copper goes down, the hinge doesn't move, right? And that's what silver's done. I mean, up until today, or a couple of days ago, here gold is breaking out to new highs versus May, but silver was down 10%. Get gold going up, and get all the industrial metals going up at the same thing. In September might be kind of a challenging month because the last five Septembers, Elijah, have averaged down about 3% for gold.
Silver has recently surged to $30 following gold's increase, but it's been lagging behind despite gold hitting new highs. While gold is rising, silver's performance has been weaker, with a notable 10% drop recently. If gold continues to rise and industrial metals also go up, September could be challenging for precious metals, as historically, gold has averaged a 3% decline in the past 5 Septembers. Craig Hemke, a financial analyst and precious metals expert, best known for his commentary on gold and silver markets, explains in August, the U.S. government ran a budget deficit of $380 billion, equating to about $11 to $12 billion per day, or $500 million per hour. However, this figure shouldn't be annualized directly, as months like April bring significant tax receipts. Despite this, the annual deficit is expected to approach $2 trillion by the end of the fiscal year on September 30th. Debt service costs have also surpassed $1 trillion annually, adding to the fiscal pressure and driving market movements as debt levels climb. Stagflation, which combines inflation with a stagnant economy, resembles the 1970s when gold surged from $35 to $800 per ounce, following Nixon's closure of the gold window. In such an environment, negative real interest rates, where inflation outpaces nominal interest rates, make holding cash or bonds less attractive, thereby boosting the appeal of gold as a foundational investment. Despite not paying dividends, gold helps protect against inflation, preserving purchasing power when other investments fail to keep up with rising costs. This is why gold often performs well during periods of negative real interest rates. Craig Hemke tells the Bureau of Labor Statistics, BLS, which produces both the Jobs Report and the Consumer Price Index, CPI, has reported that health insurance costs within the CPI have fallen 31% over the past 2 years and 10% over the last 5 years. This data appears inaccurate, as most people have experienced rising health insurance costs, not declines. The BLS's reported figures conflict with what many see in their own expenses, suggesting that the official CPI calculation might be significantly underestimating health insurance cost increases. For more videos like this, subscribe and turn on notifications. Thank you and enjoy the video.
For the month of August, the U.S. government ran a budget deficit of $380 billion for the month. 11, 12 billion a day. It's remarkable. A billion every 2 hours, 500 million an hour. Am I doing the math right? I mean, now it doesn't annualize it like that, right? You can't just go, well, it's going to be, 400 billion a month for 12 months and annualize it 5 trillion, because there are months like April, right, where you get, all these tax receipts, or every quarter, maybe June, September, and all that kind of stuff. But this kind of number is going to push the annual number when we get it early in October, when we get the look, because the U.S. fiscal year ends on September 30th. The annual number is going to be 2 trillion or very close to it, which is just outrageous. And then we now are well past $1 trillion a year just in debt service. And so you put those things together and it got us some momentum. We got above that 2560 level and broke out, and, it had to be a whole bunch of stop orders there, people that were short that said, well, on a breakout, I better cover that. And so you've had this steady move up since. The next time we had a recession, well, then there you go. That's what stagflation is. It's inflation in a stagnant economy. Very similar to what we had in the 1970s, of what gold has done or had done back in the 1970s. Broke out. It was held at $35 an ounce, and then Nixon closed the gold window, and it went from 35 to 200 in a couple of years, then pulled back 50% to 100, and then went to 800 a couple of years later. And again, I'm not trying to tell you, we're going up eightfold from here. But this stagflationary idea where negative real interest rates take hold is a very positive scenario for owning gold. Negative real interest rates. And what's a real interest rate? You take your nominal rate of interest, say it's 2% that you're earning, but inflation is 4%. You're actually losing 2% a year in cost of, in trying to keep up with the cost of living and all the other expenses that you have. You're not even keeping up. That's a negative real or inflation adjusted rate. And again, that where this impacts gold as a foundational investment is what is it? I mean, for 15 years, well, maybe not so much anymore. I always heard, well, gold doesn't pay a dividend. Right. That's fine. It also, it keeps you up with inflation, obviously. And when inflation is eating away at your savings that quickly, makes it look even better as a foundational investment versus treasuries and everything else. And that's what drives demand for it. And that's why it's so correlated over the years with negative real interest rate. Many folks know the same organization that cranks out the jobs report cranks out the CPI, the BLS, the Bureau of Labor Statistics. So when you see little things buried in that CPI report, for example, within the CPI, the calculation of health insurance costs has fallen 31% over the last 2 years. And because it rose in the first, if you look at a 5-year picture, it's down 10%, only because it was rising in 2021 and 22. So the BLS is telling us that in health insurance costs have fallen 31% over the last 2 years or 10% over the last 5. That is demonstrably false. Not just anecdotally, where, you and I are like, I don't know, that's not true. My health insurance costs are up. That is demonstrably false. Anybody can prove that it's up 31%, if anything. But yet, as a factor of the CPI, we're told it's down.
Craig Hemke, in an interview with Elijah K. Johnson, briefly explains that the U.S. jobs data suggests a growing economy. But the reality is that no full-time jobs have been added in the past 2 years. Only part-time jobs are increasing. Many laid-off workers replace good full-time jobs with multiple lower-paying part-time roles to make ends meet. This results in misleading job gains reported by the BLS. There are concerns that economic data, including jobs, GDP, and inflation figures, might be influenced by political biases, creating a skewed perception of economic strength. These reports often get revised down later, but the initial positive headlines still shape public and market sentiment. Meanwhile, mines don't directly produce refined metal. Instead, they send doré bars to refiners who process them into standardized bars, like kilo bars at 99.99% purity. Countries actively buying gold, such as Poland, Turkey, or India, usually don't purchase directly from mines. This raises the question of why these countries don't just nationalize their mines to secure their own metal supply. However, central bank gold demand is significant, and the current gold pricing system between New York and London is heavily dependent on forward and futures contracts, leveraging each ounce of physical gold multiple times. Let's have a look at the interview.
It's pretty easy to see through it. The problem is most folks are living their lives, right? And it's not an easy life to live. Go back to that jobs report from last Friday. The U.S. hasn't added any full-time jobs over the last 2 years. The only jobs that are being added are part-time jobs, okay? Even this most recent month, full-time jobs down, part-time jobs up. The simplest explanation for that is all of the layoffs you see, where the average guy, he's got a reasonably good, white collar job, if you want to call that, making 90 grand a year. And he's got benefits like PTO and health insurance and everything else. And he gets laid off. Well, that doesn't mean the dude doesn't still have to make his mortgage. He doesn't have to feed his family. He have to save for retirement. So what would anybody do in that situation, Elijah? While being on LinkedIn or whatever else, trying to find a new job, man, you're going to go sort packages for Amazon. You're going to drive an Uber on the weekend. You might even deliver some pizzas at night. That's 3 jobs. So you lost a good job. You replaced it with 3 crappy part-time jobs because you got to feed your family. And the BLS says that's a net gain of 2 jobs. Okay, so people are out there. They sense, I don't know about that. They hear the news, they hear Lester Holt trying to tell them what's going on, and they go, I don't know. if you look around, if you have the time to look around, and most folks don't because they're trying so hard to keep themselves afloat. If you look around, it's pretty easy to connect all these dots. And again, I get people all the time, oh, come on. Come on. The BLS isn't, they're not politically motivated. Really? Have you ever looked at the demographics of Washington, D.C. and Northern Virginia, where all the government employees work? They're like 95% Democrat. Do you think there's an incentive to kind of cook the books so that President Biden or Vice President Harris can go out and say, oh, look at this great economy, man, 212,000 new jobs. By the time it's revised lower, 60 days later, it's been revised twice, and now it's 110,000 jobs. And actually, they never come back out and say, oh, I'm sorry, I misled everybody. Now you get the headlines, right? And the market loves the headlines too. So again, I probably sound like I should keep a metal hat I can just put on when I talk about this stuff, Elijah. But I don't think it's a stretch to think that there are incentives to either goosing the GDP numbers, goosing the jobs number, keeping the inflation level low, so that in one thing, at least the bond market remains orderly and interest rates don't go to 8-10%. You've got to have buyers of those bonds to keep that from happening. And what would that do to the interest on the national debt, Elijah? So there's all kinds of cooks in the stew, kind of, I don't want to use the words conspiring, but loosely doing their job, working together to create this. So I'm not sure pick your country that's actively buying gold, Poland, or Turkey or India, whatever. I'm not sure they'd go to a mine. I also kind of reeks of, why don't they just nationalize their mines, and just say, hey, our metal is ours. So I'm not sure about that. I do think that the central bank gold demand is significant in a number of ways. Again, the gold pricing scheme as it is now between New York and London relies almost entirely on forward contracts and futures contracts and all these different derivatives, where 1 ounce of gold is levered.
As economic pressures mount and central banks continue to drive demand for gold, understanding the complexities behind metals pricing and market dynamics is more crucial than ever. Investors need to stay informed about how fiscal policies, inflation, and labor market shifts impact the real value of their investments. How do you think rising central bank gold demand will affect the long-term outlook for precious metals? Share your thoughts on Craig's insights in the comments below. Don't forget to like this video, subscribe to the channel, and turn on post notifications for more content like this. See you next time.